Hey everybody, I'm Skylar, and I like to dive into economics and finance. And today I wanted to dive a little bit more into the world of capital gains taxes, but more importantly, why we have a capital gains tax here in the United States of America, and how it was formed and why it was created. I think my general introduction to what capital gains taxes were was logging onto my Robinhood account and seeing that I had made some money off of the stocks that I had bought. And originally thinking that I could just go withdraw all the money I had put in, the money I had made, and just withdrawing all of it at the same time without paying any taxes. Because after all, I was the one who risked my money into the market hoping my stock would go up. Come to find out, that's not how it works. There's capital gains taxes. Upon selling your capital and the gain you have made on your capital, you have to pay a little sliver to the government. I think a general scenario of capital gains is me going in and let's say I buy $10,000 worth of stock. Let's say let's say 50,000, right? $50,000. And over the course of 15 years, this $50,000 grows all the way to $300,000, meaning I have made $250,000 in capital gains. Wouldn't it be great to just go and withdraw $300,000? That'd be amazing. Nope. The government has to take their little slice. On that $250,000 I made, I have to pay a 15% capital gains tax. So again, I pay 15% of the gain that I made. So 15% of 250,000 is going to be $37,500 that I pay to the government on my $250,000 gain. And of course, it's not just your stocks that are subject to capital gains. I actually have the IRS website pulled up, and they classify a capital gain as the profit realized from the sale of a capital asset, such as stocks, bonds, real estate, or other investments. It is calculated as the difference between the asset's adjusted basis, typically the purchase price plus certain fees, and the amount received upon sale. Now, looking at capital gains taxes, you have to really get into why they were introduced. And it really goes back to around the year 1913. You have to imagine early 20th century America. It's a place where what industries are booming? You have steel booming, you have railroads booming, you have oil booming, the Rockefellers, JP Morgan. All of these industries are booming. Prior to 1913, the United States actually had no income tax, too. So they would operate receiving tax dollars from excise tax, like alcohol, and they would receive tax money from tariffs. So the US government would operate prior to 1913 on these two bases, no capital gains, while these industries are booming, like steel, all of these industries I mentioned. And when they would go to sell large reserves of steel, oil, no money was paid to the federal government. So we start to see these figures like the president, William Howard Taft, and Representative Cordell Holt come together and frame capital gains as pretty much identical to wages. They both create economic value within the national system. So you can kind of imagine how this really affects the economy. Your laborers are getting taxed through their consumption, like going and buying bread and going and buying things that they need, right? They get taxed. While ownership generated wealth never gets taxed. So you can really see how this creates this disparity. So around the early 20th century, we see a lot of progressive reformers coming together where they want to make capital gains as income. These progressives kind of diagnose the problem not as over taxation, but actually under taxation of unearned income. So these progressives pretty much wanted one simple rule, which would be there's no special treatment. Anything you sell and you gain a profit from is earned income. So we get to 1913 and Congress ratifies the 16th Amendment, which allows the government to tax upon the citizens' capital gains. Congress shall have power to lay and collect taxes on incomes from whatever source derived. This was great in practice. It made anything that a citizen would sell qualify as ordinary income. But the true problem with this was really seen around World War One. World War One really exposed a flaw with this 1913 model. With these high ordinary rates, we really started to see something called the lock-in effect, where people would hold on to their assets in the hopes that they would not get taxed. And they didn't want to get taxed because of these high ordinary rates. So we really started to see money and capital get locked up. As we head into 1921, Treasury Secretary Andrew Mellon sees that nobody's really realizing their capital gains because of this lock-in effect. If nobody is realizing their gains because of the high tax on capital gains, no money is being sent over to the government on these capital gains because nobody's selling. So this 1921 reform introduces a 12.5% capital gains tax if you held it for more than 2 years. And data shows this. After the rate was reduced to 12.5%, the US government saw a lot more realizations. And these realizations and this increase in these realizations means more money flowing into the government's hands, even with the lower rates. So, over the course of the next century from 1921, we see the Tax Reform Act, and we see a lot of changes to this rate going up to even 40%. And now we know that it sits at 15% and 20%. So, from 0 to 20% on capital gains taxes. These long-term capital gains are taxed at progressive rates depending on your income today. So, they go from 0 to 15 to 20%. So, really, to summarize, the capital gains tax is so that the government has another source for their income. And so that people who are kind of these speculators, they go and buy land, go and buy stocks, they are taxed just like people who go and work for wages. I truly think that the capital gains tax is an important part to our economy. And I realize now that maybe I do want to do my fair share of paying my taxes when I go and put my risk into the stock market. I want to go pay my money to the government. Not everybody agrees. It's taxes. Not everybody's going to agree with everything around taxes, but just this brief history helped me learn just a bunch about really how the capital gains tax was introduced and why we still pay it. Of course, capital gains taxes are way more complicated than what I've just explained. There's situations like step up basis, there's ways to minimize your amount of capital gains taxes paid. It's a whole world of taxes out there, and it's different for everybody. But I hope I was able to summarize just a little bit about how these capital gains taxes came into our tax code and what they do for our government and what they mean for everyday US citizens. So, thanks for watching.